question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax. Brought to you by BKD CPAs and Advisors. Everyone needs a trusted advisor. Who's yours? Now here's your host, Damien Martin.
Hello and welcome to Simply Tax. It's Thursday, January 21, 2021, and on the podcast today, I'm excited to do what we enjoy doing most on Simply Tax, and that's boiling down the insights you need to know on new tax-related legislation. Today, we pick up with part 2 of our two-part look at the tax and PPP provisions of the Consolidated Appropriations Act 2021 that was enacted on December 27, 2020. Last week, we talked PPP changes with Tad Goodenbauer and James Anderson in episode 116. And today, I've asked returning guests Jesse Palmer and Yelena Bosovik to help us cut through the static of the tax-related developments of the CAA 2021. Let's get this tax party started, as they say in... Okay, seriously. Tax party? Who says that? Anyways, let's take a closer look at something we've all been living with since last March that I'll bet you didn't take a closer look at until recently, and that's the Employee Retention Credit. From the conversations I'm having, just getting a lot of, wow, I'm kind of almost overwhelmed. There's been so many changes and I don't know what's up and down anymore. A big one is the Employee Retention Credit. Jesse, maybe could kind of tee that up a little bit, some of the common questions you're getting, and really, I guess, who should be taking another look at this credit at this point in time after the recent changes?
Maybe first of all, just kind of step back and talk about what is the Employee Retention Credit. And that was something that was originally included in the CARES Act that allowed employers, if they qualified for the credit, then they could potentially receive a payroll tax credit for wages paid to employees. A lot of different rules, but essentially the criteria to be an eligible employer is you either had to have had a partial or full suspension of your business operations due to a governmental order. So this would be, a state order or a county order or even a city level order that suspended operations. Think of like a restaurant that was not able to have in-room dining would qualify as a suspension of business. So either you met that or there was a gross receipts test if your gross receipts for a quarter under the CARES Act, if it was a 50% reduction in gross receipts compared to that same quarter in 2019, then that would also make you an eligible employer. And once you went over that hurdle and met one of those tests, then you look to see how many employees do you have, because it's different based on your employee level. So if you have 100 employees or less, then essentially if you fell into one of those eligible employer categories, then all wages that you paid to those employees could qualify for this credit. And the credit is essentially 50% of wages paid during that quarter to the employee up to $10,000 of wages. So essentially the credit is maxed out at $5,000 per employee, and that's for the entire year 2020. So if you paid the employee $8,000 in the second quarter and then another $8,000 in the third quarter, then you're still limited to $5,000 total credit for that employee for those 2 quarters. Now, if you're an employer that's over 100 employees, then it's much more limited. You only receive a credit for wages that you pay to an employee for the time that they're not performing services for you. So if you're paying an employee to stay home, but they're actually not doing any work, and then those wages could qualify. Or, say you had to furlough some employees, but you were still paying for their health insurance. Health insurance qualifies as qualified wages, so you could take the credit on, the allocable amount of health plan expenses to that furloughed employee. So definitely, much more favorable for the smaller employers with under 100 employees. And probably important to note that test is based on average full-time equivalent FTEs, but under that test, it's a 30-hour threshold. So if you had an employee that worked on average less than 30 hours a week or 130 hours for the month, then they are essentially not counted toward that limit. So if you're an employer that has a lot of part-time employees that all on average work less than 30 hours, even though it may be in total you have over 100 employees under this FTE calculation, you could still fall under that 100 FTE threshold. So something to keep in mind in terms of when you're doing these calculations.
What changed for 2020 and what does that mean essentially?
But I guess the other point also to keep in mind for 2020 under the CARES Act, the original rule was if you were an employer that took out a PPP loan, then you weren't able to take advantage of the employee retention credit. So it was kind of an either or. You either took a PPP loan or you potentially could take the employee retention credit. You couldn't take both. So again, that was under the original rules when the CARES Act was implemented. Now under the Consolidated Appropriations Act, that changed. So there were kind of two buckets of things that changed with are we calling it CAA?
I think so. I've been calling it that. Yeah.
Or Appropriations Act. I don't know what you want to call it.
Or spending bill or something. I don't know. It's the legislation. I've been taking that shortcut lately. The new legislation.
The new legislation. So, under the new legislation, there's kind of two different buckets that changed. You got one bucket that kind of applied retroactively to when the CARES Act was enacted. And the big thing in that bucket is PPP borrowers are now eligible to claim the employee retention credit. However, you can't use the same wages that were used to receive loan forgiveness to also qualify for the ERC. So, no, you can't double dip on the same wages. So that was the big retroactive change that was made under the recent legislation. The other big thing was for the ERC, they extended it to the first 2 quarters in 2021. So essentially from January 1st to June 30th of 2021, the ERC is available, but it's expanded. So essentially, instead of the 50% of wages up to 10,000 of wages or 5,000 max credit, it's now 70% of wages up to 10,000 of wages per quarter. If you look at the 2 quarters in 2021 and you paid an employee $10,000 each quarter, instead of a $5,000 limit overall, they now get $7,000 per quarter. So for that employee, you can potentially receive up to $14,000 of credit for an employee that you paid over $10,000 to each quarter in 2021. So that was definitely a big change that I think will make it much more attractive to employers in 2021. And the other big change was they increased that 100 employee threshold limit. Instead of 100 or less employees where you're able to take the credit on all wages, they increased that to 500 employees or less. So that should obviously capture a lot more employers to be able to obtain the more favorable credit calculation in terms of getting the credit on all wages paid versus just the wages that are paid to those employees that aren't providing services. And the other change that was made for the 2 quarters in 2021 is the gross receipts reduction. So again, you had to either had a full or partial shutdown due to governmental order or meet a gross receipts test. Before, you had to have a 50% reduction in gross receipts compared to the same quarter in 19. Now, for 2021 quarters, that you only have to show a 20% reduction in gross receipts. So that, again, should also make it much easier to qualify when you're comparing first quarter of 2020 to the first quarter of 2019. Also, there's an election that's available if you want to use the immediately preceding quarter to do that test. You're able to do that as well. So for first quarter of 2021, I could elect to use my fourth quarter of 2020 gross receipts and compare that to fourth quarter of 2019 to see if I meet that new 20% or more reduction in gross receipts. So definitely some very favorable changes that, again, should make this a much more lucrative credit for employers to receive as a credit. Again, it's a payroll tax credit, so it's claimed on the payroll tax return, but it is refundable. So any credit in excess of the payroll tax liability can be refunded to the employer.
Which makes it, really available to both, for-profit and not-for-profit organizations, right? And taxpayers, since as long as you have payroll and there's payroll tax being paid. And I know, Yelena, you went through and helped, and we'll talk about some of the other credits that are also payroll credits here in a bit, but Maybe you could talk to that a little bit about, again, it's on the payroll form, but what if we're looking back to 2020? I don't know, could you speak to that at all, of what maybe people should be doing even at this point in time, if at all?
Yeah, so the payroll forms for 2020, I think starting with the second quarter, were amended. So now there's a line for each of these credits, and also a line for the payroll tax deferral that President Trump signed as an executive order. So there are lines that have been added to those forms. So not only do you have to fill out those forms, but there's also specific documentation requirements for each tax credit. There's been guidance issued on all of that, and it's important to keep that documentation for each employee that you are paying wages to for any of these tax credits that are associated with those wages.
Now would actually be a good time to talk about those other credits that were amended there, or the form was amended for rather, and added in. And then maybe we can kind of have you both kind of talk through maybe some of the, I don't know, misconceptions or questions or those sorts of things that people are getting right now. But obviously, we also had the credits under the Families First Coronavirus Relief Act. We saw that a change there with the most recent legislation as well. Could you talk about that and maybe what that means?
The FFCRA had paid sick leave credits as well as tax credits for extended family leave. So all these rules were under the Department of Labor, so it's kind of different. It's tax credits, but it was mostly most of the guidance was through the Department of Labor. Those credits technically expired at the end of 2020, but this new legislation extends the credits through March 2021, so through the end of that month. And there's a subtle nuance that kind of changes effective January 1st, because the new legislation did not extend the corresponding employer mandate to provide the paid sick and family leave. So employers who were mandated under the FFCRA in 2020 to provide this leave are no longer under that mandate in 2021. But if they choose to voluntarily provide that leave as if the mandate was actually extended, then they can still get the tax credits for the eligible wages. So think of it as almost like an alternative reality where their mandate was extended through the end of March 2021, and you can still get the tax credits, but really the mandate wasn't extended, only the tax credits were. So it's an interesting situation that we find ourselves in, but it does give people a little bit more time, I guess, employers and employees, to have access to this leave and get tax credits to pay for the leave.
And so generally the way, and this is again a very broad brush, I guess I'll say, way of describing it, because the rules are very specific, right, for those credits, and the guidance is also very specific that's been issued. But more or less, it's dealing with an employee or a dependent or family member there that actually had or was diagnosed with COVID-19, right, and then they're having leave that's being paid for that purpose. Is that kind of way to look at it?
Yeah, so there's two types of leave. There's paid sick leave, which is essentially leave for yourself or you're taking care of someone who's been diagnosed with COVID. And there's extended family leave, which is under the FMLA rules, and it provides, I believe, up to 10 weeks of paid sick leave if you're taking care of someone who has COVID or other reasons that are listed in the regulations. So there's guidance again through the Department of Labor that provides all the rules and, again, documentation that you would need to substantiate why you're providing this leave. It's just a little bit more of a gray area now in 2021 because employers are no longer mandated by law to provide this leave. So it's more of a out of the goodness of their hearts if they want to do that, and they get tax credits if they do, and if they don't, then they don't. So it'll be an interesting development for us in 2021.
You've highlighted those documentation requirements at least twice there, and I think that is a key point, and making sure that everyone's aware that needs to happen, because the mechanism, again, is you're going through payroll and you're working with your payroll provider, but that doesn't, you're telling them what to do. They're not necessarily signing off and approving on it, which I think is something I've heard as a, again, misconception perhaps. It sounds like that documentation is pretty important.
Yeah, it is. And I think the thing is, we're tax people, right? I mean, most of us don't practice labor law, but all of this is under the labor regulations, which do have more stringent documentation requirements if you're providing someone with paid sick leave or expanded family leave. So it's not necessarily it is for the tax credits, but you have to remember that there's this corresponding like laws and rules and regulations that apply that maybe we don't generally interact with a lot, but now just kind of came into our sphere that we practice in. And so, for example, if you're claiming paid sick leave because you're taking care of a child's school that was closed due to COVID, the documentation rules recommend providing the notice specifically from the school to support that. So it's little things like that maybe we don't normally would do for tax credits, but in this case would apply.
And probably one other thing, Yelena, on the FFCRA credits, just to make people aware of, people kind of look at this as, well, this is an employer tax credit, but there is a similar credit available for self-employed individuals. So let's say you're not an employee, you're self-employed and you have your own business, maybe it's Schedule C business or whatever it is. There is a potential, if you have been impacted and had days that you were, either not able to work because of COVID or days you had to take care of a family member because of COVID, there is an equivalent credit that's available for you on the 2020 1040. There's a new form that would need to be filled out to report the number of days, but there is a potential even for self-employed individuals to receive a credit.
Keep using kind of the term misconception, and maybe it's more important things to keep in mind, I guess, or considerations. Jesse, kind of again, maybe looking at these two credits, FFCRA credits and the employee retention credit. I don't know, what would you say kind of fits in that bucket based on what you're hearing now that we're into the new year and the new law, I should say, is getting a little bit older here, and we've had some time to work with it.
Normally how the statutes are, there's a lot of holes, I guess, to be filled in terms of the details once you get the statute. And, I think many of us thought, well, the IRS or Treasury will probably issue regulations or notice or something to kind of fill in some of those details with the ERC. And understandably, in terms of expediency and getting out guidance for people, the IRS took the route of an FAQ on their website. They've issued, I'm not sure how many's out there now, 60, 70 FAQs that they issued related to the ERC and FFCRA credits. But that's really how we've been receiving guidance in terms of some of these unique situations or questions we had that aren't really directly addressed by the legislative text of the CARES Act or now the new legislation. I think it did help address some of those situations. I think one that I hear a lot is, okay, I've been employed with multiple locations, and maybe one of my locations is in a locality that did have a governmental order that required me to have a partial or full suspension of my operations. But I also have, these other locations that are in places that weren't shut down. Does that mean I only get to take the credit on the location that was? And I think pretty favorably, the IRS FAQs say that, as long as one of your locations experienced a full or partial shutdown due to a governmental order, then all your locations could qualify. So I think that's one to definitely keep in mind. Also, if you're like a hospital, this is one we've heard a lot too, in terms of hospitals obviously are essential for services that weren't shut down by any of the orders, but a lot of hospitals maybe had to shut down their non-essential, their elective type surgeries. So what if you're a business that had part of your operations were shut down, but you were an essential business? So does that mean you don't qualify? And I think the IRS came out with some good examples that say, well, since you had to stop doing elective surgeries, you could still potentially qualify as an eligible employer. So I think there's definitely some good highlights and examples that you can glean from the IRS FAQs that were issued. But I'd say the biggest one, if you were a PPP borrower, this credit really didn't apply, so you probably didn't pay a whole lot of attention to the rules or whether or not you can qualify. So the fact that this is retroactive, the change that now allows you to qualify for the ERC, and if you took a PPP loan, really does open the door for those borrowers that maybe didn't really drill down into this and look at this very closely to go back and look, because I think it does open up some potential refund opportunities for 2020 to the extent you had additional wages that weren't paid with PPP loans. And I know you have probably a different interview with other people on the PPP provision, so we'll get into that a lot.
Yep, we sure did. And you can check it out if you haven't already with episode 116 that I mentioned at the top of the episode. We've included a link in the show notes, which is where you can also find additional resources like our ERC flowchart on both the 2020 and 2021 version of the ERC, as well as articles and archived webinars to take a deeper dive on the changes and what they mean for you and your business. You can find it all at bkd.com/simplytax. So what's one thing to keep in mind on this, Jesse?
I think one thing to keep in mind with the PPP, kind of have this 40% bucket that you're able to use for non-payroll costs, eligible non-payroll costs. most people didn't really pay attention to that because, with the 24-week covered period, they have more than enough wages to cover their PPP loan. Maybe they need to go back if they haven't applied for forgiveness yet, reevaluate what they put on their forgiveness application to take advantage of that 40% to maybe free up more wages that can now qualify for the employee retention credit. So certainly, I think a lot of work that people need to take a hard look at and make sure that they're not leaving money on the table for these prior quarters in 2020. And I think the other kind of nice thing that was thrown into the legislation was this option, instead of going back and amending your second and third quarter payroll tax returns to claim the credit, there is an election that we'll have to see how the IRS implements it, but a potential election to essentially kind of catch up and treat those wages as paid in the fourth quarter and be able to take that credit on your fourth quarter payroll tax return, which obviously avoids the administrative hassles of amending prior payroll tax returns.
With everything, there's always the gaps that need to get filled in, and definitely looking for that guidance here. Lane, anything you'd add on the subject of the payroll tax credits, now we're maybe taking a second look or an extended look at them?
Yeah, I think the only thing I'd add is that as far as the paid sick leave credits and the extended family leave, those are not renewals for 2021. It's an extension, which means that the same qualifications apply as they did in 2020. So it's small to mid-sized employers. You don't get to start over as of January 1st of like how many hours you can get of paid sick leave or expanded family leave. So it's an extension. So if you used up all your hours in 2020 as an employee, you don't get more hours in 2021. That's it. But if you still had some hours that you could use and you just didn't use them in 2020, you can still use them in 2021.
Well, maybe we'll leave the payroll tax credits. I mean, it's huge benefit and relief opportunity for those that can qualify. Like I said, you gotta mind the details, and maybe we have some more details to come. But there are obviously also a lot of other income tax, we'll say, related items that were in the bill as well. So maybe, Jesse, we'll start with one that I know had been kind of batted around a bit, and it kind of got included there, it got down to the wire in terms of it getting finalized, and that's, of course, the business meal deduction and change they made there. So you talk about that and maybe what we know and also don't know about the change there?
Yeah, that I think that one was a bit surprising that I got thrown into this legislation. I think it's probably one of the negotiation points to come to an agreement between the Congress and the White House, because this is really something that President Trump has been pushing in terms of providing 100% deduction for business meals. Just as a background, kind of the general rule is any meals that are incurred in a business, if you take a client out to lunch, then for an example, that typically is limited to a 50% deduction. And then under the tax reform, obviously there was also restrictions put on entertainment. So essentially entertainment is 100% non-deductible, but the meals portion typically is still 50%. Now there are some exceptions where maybe you can get 100% of that meals as a deduction, but general rule for kind of your standard, taking clients out to lunch or dinner or whatever, those type of meals are generally 50% deductible. Under the legislation, and kind of under the purpose of this being to help stimulate more business for restaurants and that are impacted pretty severely by the pandemic, to help kind of generate maybe more business for those type of industries, is to essentially provide employers or businesses the ability to deduct 100% of those meals effective for amounts paid or incurred after December 31st of 2020. So, if you're a calendar year taxpayer, then essentially all your meals qualify under this rule. You can now take 100% deduction in 21 as well as 22. It's a 2-year kind of temporary provision, so it's not permanent. Currently, it's just a 2-year kind of reprieve from the 50% haircut. But for those 2 years, there would be 100% deduction available. But the statute basically just says from a restaurant. And that's probably going to open up some questions and need some guidance, I suspect, from Treasury IRS in terms of what can qualify as a restaurant, because obviously you've got a lot of meal delivery type services now and so forth. So does this mean you have to physically go to the restaurant to have the meal, or as long as the food is coming from what you normally would think of as a restaurant, would that qualify? Or like food carts or food trucks, would those qualify as restaurants? So I think a lot of interesting scenarios out there that I'm sure there will be questions about in terms of, does this meet the restaurant requirement to meet the 100% deduction? But at this time, there probably still isn't a whole lot of meals being eaten in restaurants. But later in 21 and 22, when things hopefully kind of return back to normal, this could be certainly a nice additional deduction for businesses that do incur substantial amount of business meals.
At the very least, perhaps it also is a great reminder of some of the kind of basic tax planning, I guess I would say, or execution. I always say of taking a look at what's in that meals account anyway, right? And seeing, again, making sure you're taking advantage of the different buckets that do still get the full deduction. And now we got a new one, right? These restaurant meals. But maybe another area, I guess some of the changes have helped to maybe tee up and revisit. That's also some solid tax planning, I guess I'll say, is on the charitable side. And Yelena, I know that we had some changes under the CARES Act on the charitable deduction for individuals, primarily looking at, because those are the ones that were, I guess, extended here with the recent legislation. So could you talk about those and maybe how also maybe I know there's a small change there on one of them.
For taxers beginning in 2020, taxpayers who do not itemize their deductions are allowed an above-the-line deduction of up to $300 for qualified charitable contributions. And this recent legislation kind of slightly changed that for 2021. So it's the same rule for 2021, but married couples can now deduct up to $600 as an above-the-line deduction for 2021. So in 2020, it's $300 for single and married, and then it goes higher for 2021. And there's several other changes to charitable contributions for those who do itemize their deductions, as far as removing some of the limitations and just expanding more opportunities to participate in charitable giving and get tax benefits for that. And we have a lot of thoughtware on bkd.com explaining each one of those and how to take advantage of that for 2020 and 2021.
Things to think about there, definitions that are important, but it definitely a tax opportunity, I guess, to go along with the ability to also help out those that are in need in this current environment that we're in. There was a lot in here, right? It is typically the case when you get to the spending bill and extenders and things like that. But maybe we'll start with some of the rapid fire ones. Jesse, I know there was an extension we talked about that executive order from back in August. Could you talk a little bit about that and what was provided in the legislation?
Yeah, so this kind of goes back to I don't know, when was it, September, August timeframe, when President Trump issued that executive order to essentially provide a deferral opportunity for employees to defer their share of Social Security tax incurred for kind of the latter part of 2020, to be able to defer that until 2021, with kind of the expectation of, we'll try to get legislation to ultimately forgive this or something. But obviously under the executive order, they didn't have the power to forgive it, but under kind of some of their disaster relief authority, they were able to at least postpone payment of that employee Social Security. And certainly a lot of questions when that came out, and IRS Treasury came out with some guidance a few weeks later. A lot of questions from employers in terms of, what does this mean? How do I report this? What if an employee leaves before they pay it back in 2021? Treasury came out with some guidance in terms of the mechanics of how that would be paid back, essentially requiring it all to be paid back in 2021 through first 4 months through April 30th, I believe. So kind of prorating over that time period is kind of the payback period. So essentially this was kind of a short-term loan, so to speak, for employees, by maybe bumping up their paycheck in 2020 time period, but having to kind of recapture that in early 2021. But obviously, because of the short-term deferral opportunity and still kind of the unknowns about who's going to be on the hook for repaying it if an employee left early and so forth, many employers opted out of participating in that postponement deferral opportunity. A big chunk, I think, that did, due to an order was the government. So a lot of government employees were essentially forced to take part in this. It really wasn't an employee by employee decision. It was an employer decision whether or not to defer that Social Security. So certainly a lot of government employees saw their Social Security being postponed until 2021. So, as part of the legislation to help provide a little bit more relief for those that had that Social Security tax postponed, they extended the kind of the period that it had to be paid back to December 31st of 2021. It's still not forgiven entirely, so it still has to be paid back, but it gives the employees a little more time to repay that amount that was postponed in 2020. Now, as far as how the mechanics of that will work, we're still waiting on guidance in terms of, is our employer still going to have to withhold like 1/12 of that each month, or can they opt to withhold the extra amount, later in the year, or how exactly is that going to work remains to be seen. But that was included in the legislation.
Yeah, and interesting too, because I know a lot of those that I talked to decided not to go for it because of concern of, well, what happens if an employee leaves, and then we're on the, maybe the employer is left holding the bag, so to speak, for paying that. And I guess now with the extended period, that maybe could exacerbate that, I guess. But yeah, we'll have to kind of see how that comes to bear. But again, from a rapid fire perspective, Elaine, I know there's some unemployment benefit changes, but there are a number of others too. So maybe I'll just tee it up to you to say, what are some other ones that you would maybe mention, or you think that people would be interested in knowing about, at least high level? And obviously, we've got the article that you co-authored out there as well, and in our archive of our December 28th webinar that we did as well as kind of resources here. But what are some other odds and ends that you kind of mention?
Yeah, I think there's two that I've been getting the most questions about. The first one is the second round of stimulus checks. So I think I get the most texts and phone calls from family and friends about that recently, asking when they're getting that money. If we remember back in the spring, early summer, we got the first round of stimulus checks, and Congress did pass a second round. So it's all the same requirements, same logistics of getting the money out. The only difference this time is that it's a little bit less. So it's 600 per an adult, and so 1,200 for married couples, and then $600 for each qualifying child. And they're still defining that as a dependent child under the age of 17. So that again rules out college students. So again, same thing as last time, just different amounts. It starts phasing out after 75,000 for individuals and 150,000 for married couples and adjusted gross income. And this is off 2019 numbers, even though it's a 2020 tax credit. And as far as when to expect this, the IRS and Treasury have started sending out direct deposits as of last week, and checks are also going out. And then some people will be getting debit cards mailed to them. And the Treasury has said that this all should be happening throughout the month of January. They're just doing it in batches. And so people should look for that. There's no action required to receive this. And the IRS specifically said to not call them and ask questions about this. They're sending the money out as soon as they can. If you don't get the money, you can claim the credit on your 2020 tax return and get it with that refund.
Because it's based on 2020, obviously, they base it on 19. What if you got too much? Do you have to give it back? Do they change that at all, or is it still the case that you don't have to give it back if you got more than you would calculate it in 2020?
So you don't have to give it back, but I think the only exception I've seen is if you receive money for a deceased person. So if a relative receives money for a deceased person, the IRS has issued guidance on how to return that money. So I think that's the only one I've seen where you would have to return it.
Okay. But you said you had another one too, or
Yeah, unemployment benefits. So
yeah.
the federal unemployment supplement, which most often people hear it referred to as FPUC, was created by the CARES Act, and it provided $600 a week in additional federal unemployment benefits. So this is on top of state benefits. And this expired July 31st, 2020. Once that expired, President Trump in August signed an executive order that delivered $300 per week, and it used FEMA funds to do that, but it really quickly ran out. So there has been a little bit of a gap in receiving this additional unemployment benefits. So the new stimulus bill restarts the CARES Act unemployment supplement, but this time it's $300 per week for 11 weeks. So these payments will restart December 26, 2020, and first apply to unemployment weeks that end on January 2nd or January 3rd of 2021, depending on the state. So again, these programs are based on state unemployment programs is just a federal supplement that's kind of tacked onto that. So the rules will vary state by state. It will run through about March 14th, 2021. And then depending again, if you start the week on Saturday or Sunday, that date will be kind of different as far as when you get the last check. But again, there's no really general rules that I can share because it's a state by state basis. So when you receive the check, it depends how fast your state will implement this. And as far as the actual benefits too, I mean, the federal one is $300 a week, but state by state, again, it varies. So check with your state. Usually it's on the labor website for each state for the information on this.
So Jesse, as we often do, we now in many cases have these extender provisions that seem to come up in the conversation right at the end of the year. And again, there's a lot there. What are a few that stand out to you that you think are important for people to know, particularly as they're getting to the tax time here and maybe doing some planning as well?
Yeah, this is kind of an exercise we've all been through a few times over the years because there are certain provisions in the code that aren't permanent and have expiration dates, and typically we see Congress kind of last minute or even after expiration retroactively go back and extend some of these provisions. We saw that for many years with like the research credit that was just, I don't know how many times that was extended over its life, but it was made permanent into the code a few years back. But we still have a handful of these type of provisions that are still kind of temporary in terms of 1 year or 2 year type lives for these various credits and other deductions and so forth. So under the recent legislation, there was kind of different buckets, I guess, of extender provisions, and kind of had one bucket of a few provisions that were permanently extended, and kind of use that term permanently loosely in terms of the code, because even if it is permanent, it's still obviously subject to change due to any future congressional action. But at least as of right now, there were certain things that were permanently extended. Probably one of them that probably has the most applicability would be the energy efficient commercial building deduction, which is essentially an acceleration of depreciation based on a certain dollar amount per square foot. But it essentially is for if you have a commercial building that you make certain energy efficient improvements to, then you could potentially qualify for this kind of accelerated deduction of your normal depreciation on that building. Also, if you're a architect or engineer or something that does this work on say a government-owned building, there is a potential that you can receive an allocation of kind of what that benefit would be. So there is kind of two different ways you can benefit from this. But essentially, if you're a business owner that you have a building you're making improvements to, this is potentially a provision that could benefit you, and that has been permanently extended under the recent legislation. And then also, some permanent continuation of reduced excise tax rates for certain beer, wine, spirit makers, kind of your small craft brewers and so forth. Saw some very beneficial changes by permanently extending kind of the current reduced rate that applies to those type of products. And then also under the permanent bucket, there was a reduction for individuals that are able to take advantage of medical expense deductions as itemized deductions on their personal return. That threshold that you have to exceed before you can really benefit from those medical deductions has been permanently reduced down to 7.5% of AGI. So basically, until your medical expenses exceed that 7.5% of adjusted gross income number, that's when you'll start to receive a benefit for those medical expenses, is the amount over that floor. So those are your big permanent extension items. And then you had kind of a separate bucket of items that were extended through 2025, which coincidentally is also the time frame for when various provisions under the Tax Reform Act also expire, such as the qualified business income deduction and some of the other provisions. So certainly we'll be interested to see what happens there in terms of legislation as we get into 2025 and what happens there when all these things expire. But in terms of what was in that bucket, some of the big ones were definitely the work opportunity credit, which is something a lot of employers take advantage of in terms of if you're hiring employees in certain targeted groups, then you're able to receive a tax credit for a portion of the wages paid to those employees. Another big one that I received a few questions on already is something that's fairly new. Part of the CARES Act was this ability for employers to exclude certain employer payments of student loans under an educational type program an employer may have for their employees. So essentially for 2020, if I pay up to $5,250, I believe is the limit of an employee's student loan, then that is treated as tax-free to the employee. So under the CARES Act, that was kind of a very temporary provision through 12/31 of 20. Under the recent legislation, that has now been extended out through the end of 2025. So certainly something I think from an employer standpoint, when you're looking at your employee benefit package and ways to recruit and retain employees, I think that's certainly one that needs to be kept in mind, because I think it can be a fairly nice way to provide a benefit to an employee on a tax-free basis. So those were probably a couple of the, I would say, more significant ones in kind of that bucket. And then he had kind of another list of items that were extended for a much shorter period of time, so either through 2021 or 2022. A lot of these really kind of fall into kind of the energy-related credit area. There's various credits for certain types of alternative energy or production of certain types of alternative energy. One that many people probably are familiar with is a residential energy credit, where if you make certain improvements to your residence in terms of energy efficient furnace or things like that you can receive potentially a personal credit. So those type of things were extended through either, like I said, either through 2021 or 2022. So certainly something to just keep in mind. And a lot of these are ones that aren't going to apply to a wide swath of businesses or individuals, but if you're in one of these areas that could take advantage, definitely want to at least be aware of what's in there and making sure that you're not overlooking potential credit opportunity or deduction opportunity.
It's almost overwhelming how much it gets included in the changes and what's even on the horizon, like you said, when it comes to things that expire with the TCJA and maybe even some things that start even next year, I guess, now that we're into 2021, with some of the ramp down of and things kicking in under the Tax Cuts and Jobs Act, which we'll circle back on. But I mean, maybe if I get maybe kind of pulling things together to that end of things you would leave people with, and maybe even as we look ahead here into 2021. Yelena, what's the kind of the key takeaways, or what would you tell people in light of this most recent legislation?
Talk to your tax advisor. We're paid to know this stuff. We are generally good at what we do. There's a lot of nuances to all these new rules, even the expanded rules. So just because it was one way in 2020 doesn't mean it's the same way in 2021. And we are good at helping you look for opportunities to increase cash flow, help your employees, lower your tax liability, whatever tax planning we can help you. Same with tax compliance too, figuring out the best way to file your 2020 tax returns and then plan for 2021.
Now, Jesse, what advice would you have for everybody kind of just in approaching all this right now?
As if things weren't complex enough and crazy enough, now we have another 5,000 plus pages of legislation, not to mention just the thousands and thousands of pages of regulations that are still coming out from Treasury on the tax reform implementations.
He's right. Well, there's been a lot going on with the latest legislative developments. There's also been a flurry of activity on the Tax Cuts and Jobs Act front, and there's a lot more to unpack there as well. But don't worry, we'll be back on your feed soon enough with insights on the latest TCJA-related guidance with those thousands of pages of guidance, so be sure to subscribe so you don't miss out, and leave us a rating and review on Apple Podcasts so others can find us as well. Don't forget to check out those show notes of this episode available at bkd.com/simplytax to learn more about Jesse and Yelena and get those additional resources on the CAA 2021 that I mentioned earlier in the episode. And if you're looking for more from me, you can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.